All right, let's dive right in. Today, we're breaking down a really sharp 4 ETF strategy, specifically built to create a powerful portfolio for the 2026 landscape.
This is the big question, isn't it? It's on every investor's mind. When you look at the forecasts for 2026, they're messy. They're anything but simple, which makes figuring out a winning strategy feel tougher than ever. So, where do you even begin?
This quote just nails it. It gets right to the heart of the whole problem. We're not in a market where a rising tide lifts all boats. We're staring down a K-shaped economy. And what that means is some sectors are going to be on a rocket ship up, while others are heading straight down. The real trick is knowing how to catch that upside while shielding yourself from the downside. It means you have to play offense and defense, both at the very same time. So here's our game plan for this breakdown. First, we'll unpack that 2026 investment puzzle. Then, we'll talk about why ETFs are really the perfect tool for this specific job. After that, we'll get into the 2 core pillars of the strategy, the growth engines and the defensive core, before tying it all together into your complete 2026 ETF blueprint. Okay, first things first. Let's really dig into the specific challenges that make the 2026 environment so darn tricky to navigate. You see, all of these factors are tangled up together. You've got this sticky inflation hanging around 3%. That probably means that interest rates stay higher for longer, which puts the squeeze on certain growth companies. At the same time, all this geopolitical instability creates both risks and opportunities, especially in a sector like defense. It all just feeds back into that K-shaped world of clear winners and clear losers. So you might be wondering, with this complex mess, why are we zeroing in on ETFs? Why exchange-traded funds? Well, it all boils down to a really clear, really powerful structural advantage. This slide lays it out perfectly, head to head. With ETFs, you get to trade all day long just like a stock. You see exactly what's inside every single day, and they're cheaper. But the real kicker, the most important advantage for this strategy, especially if you're investing in a taxable account, is tax efficiency. ETFs are just built from the ground up to generate way fewer taxable capital gains than old-school mutual funds. And this is the secret sauce. It's called the creation and redemption mechanism. It sounds complicated, but here's the deal. In a mutual fund, when people want their money back, the fund has to sell stocks, which can trigger a tax bill for everyone left in the fund. ETFs have this clever workaround. They can trade stocks in kind, like a swap, with big institutions. This lets them get rid of the shares that have the biggest built-in gains without creating a taxable event for you, the investor. It is a huge structural benefit. Okay, let's start building our portfolio. Pillar number 1 is our offense. This is where we're going for growth. We're going to aim to capture 2 massive long-term megatrends, artificial intelligence and healthcare. These are what we call secular trends, huge society-shifting movements that really don't care about the day-to-day jitters of the economy. Our first pick for the growth engine is SMH, the VanEck Semiconductor ETF. And the logic here is just simple but incredibly powerful. Instead of trying to guess which AI app is going to be the next big thing, we're investing in the companies building the actual hardware, the chips that everybody needs. It's the classic picks and shovels play for the AI gold rush. And this is a high-conviction fund. You can see it right here. Over a third of its entire portfolio is in just 3 companies: NVIDIA, Taiwan Semiconductor, and Broadcom. These are, without a doubt, the leaders building the foundation for AI. This ETF gives you a direct line to the heart of the revolution. That's the upward-sloping part of our K. Our second growth engine is OZEM, the Round Hill GLP-1 and weight loss ETF. Now, this is a specialty fund, which means it's laser-focused on one very specific theme, the healthcare megatrend of GLP-1 drugs. Think Ozempic and Wegovy. And listen, this is way bigger than just weight loss. This is about a fundamental shift in how we treat metabolic and cardiovascular diseases. And whoa, if you thought SMH was concentrated, get a load of this. OZEM puts almost 35% of its assets into just the 2 giants of the GLP-1 space, Eli Lilly and Novo Nordisk. This is a huge bet on a very specific, game-changing trend. It's designed to generate what's called thematic alpha, basically returns that have nothing to do with what the broader market is doing. All right, we've got our offense set. Now it's time to build the other side of our strategy, the defense. This pillar is all about providing stability, kicking off income that actually beats inflation, and hedging against that very instability we talked about at the beginning. Our defensive anchor is SCHD, the Schwab U.S. Dividend Equity ETF. Look, in a world with 3% inflation, you need assets that don't just sit there. You need something that grows your purchasing power. And that's exactly what SCHD aims to do by investing in rock solid, high quality companies with a proven track record of increasing their dividends year after year.
And this right here is the key number, its current dividend yield. At nearly 4%, it's designed to provide an income stream that comfortably beats that projected 3% inflation rate, and that is absolutely crucial for protecting your wealth.
And here's the kicker, you get that incredible income for an incredibly low price. This is its expense ratio. We're talking just $6 a year for every $10,000 you invest. High income, super low cost. That is a seriously powerful combo for the defensive core of any portfolio. And the final piece of our puzzle is ITA, the iShares U.S. Aerospace and Defense ETF. Think of this as our portfolio's geopolitical shield. The companies in this fund, we're talking major defense contractors, get their money from stable, long-term government contracts. That makes their business way less sensitive to things like economic cycles or what consumers are spending. And this chart shows exactly why it's such a compelling idea right now. You can see the sector is projecting really strong earnings growth, and look how it accelerates, up to over 13% by the middle of 2026. This isn't just a guess. It's driven by budgets that are already in place and rising global demand, making it a powerful and timely addition to the lineup.
Okay, so we've covered the offense and we've covered the defense. Now let's put all the pieces together into one single, clear, and actionable blueprint.
And here it is, the whole shebang, your complete 4 ETF strategy for 2026. You've got SMH as your AI growth engine. You've got OZM giving you that concentrated shot at the healthcare megatrend. You have SCHD as your super low-cost, high-quality defensive core, and ITA is your geopolitical hedge. Put them together and you have a balanced portfolio built specifically for that K-shaped world we've been talking about. But of course, no strategy is risk-free, right? It's really important to keep an eye out for an inflation shock that could hurt our growth pillars. Valuations in AI are definitely high, so those companies need to deliver on earnings. And for healthcare and defense, you always have to watch for shifts in regulation and politics. Being a smart investor means always knowing what could go wrong. So, there you have it. A clear blueprint for navigating the complexities of 2026. It's about combining that high-conviction growth with rock-solid defense, and doing it all through the super efficient structure of ETFs. The blueprint is ready. The only question left is your portfolio?